Two banks have gone under in the US in the past fortnight, both victim in part to the unprecedented pace of rise in interest rates by the US Federal Reserve. However, the US Fed has pressed on with rate hikes, raising the benchmark rate by 25 basis points to 5%, its highest level in the past 16 years. There are signs, however, the rate hikes may soon be paused.
Over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation.
The Fed chairman stressed that the recent banking crisis was not systematic and reassured depositors, consumers, and businesses that the system was sound after the spate of actions that the central bank and other regulators have taken in the last 2 weeks.
The banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again.
Analysts were left puzzled over a statement by the US Treasury Secretary, Janet Powell, that the government was not considering blanket insurance of banking deposits following the collapse of the Silicon Valley Bank and the Signature Bank. An earlier comment by her had hinted at the US government planning to raise the deposit guarantee from the current $250,000.
So, we look forward to working.
So, Madam Secretary, does insuring every deposit at every FDIC-insured bank in the nation over $250,000 require congressional approval?
This is not something that we have looked at. It's not something that we're considering. All that I have said is that when the failure of a bank is judged by supermajorities of the FDIC board, the Fed board, and myself in consultation with the president, when such a failure is deemed to create systemic risk, which I think of as the risk of a contagious bank run, that we are likely to invoke the systemic risk exception, which permits the FDIC to protect all depositors.
Meanwhile, the Reserve Bank of India is set to make its interest rate outlook clear in the first week of April. The 3-day Monetary Policy Committee meet ends 8th April, when a nominal repo rate hike is expected. Bureau Report, Business Today TV.
If you like the video, do like, comment, share and subscribe.